those are great investors to use as references. If I'm talking to the sponsor, if you've got an investor that had a deal that didn't go perfectly as planned and things went wrong, and you can use them as a reference, that speaks volumes to who you are as a sponsor. So if you've got anything like that, a limited partner, as a limited partner, I would say, hey, can I have a referral to an investor that was part of a deal that didn't go as planned? And if you've got that, if they can provide that for you, and that's a good reference, that's fantastic, because that speaks volumes to how they acted as, the person in charge.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it.
Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars. to claim your free course today. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and with me as always on these hump day hustles is John Stiles with Bridge Realty. John, how are you doing today?
I'm doing pretty good, Todd. If I can be honest, my new year hasn't quite gotten off to the great start I was hoping. We got back from our little vacation to Iowa to see the family, and that was all good, but then we decided to come down with our usual colds and coughs and and just pass it around the family. So had to get, and of course the kids are still off break when we're recording this, so I'm just going to chalk it up to still on vacation. So
the kids are still on vacation this week?
Yeah, we get the full week of the first week of January. So
wow. My kids are back at it, so that's good.
So you're back in the saddle, huh?
Oh yeah. So we went to Montana over. We flew out on Christmas. We got back on New Year's Eve. It was a ton of fun. It was fantastic weather out there as far as skiing goes. It snowed. I think every single day we had snow. Most of the days it was only like an inch or two. But the last 2 days was fantastic. We were at Big Sky the second to last day, and there was, I think that was like 5 to 6 inches when we were there. And then the following day we were at Bridger Bowl, which is right, really close to Big Sky. And that day we got like 6 or 7 inches. So it was just great. It was a lot of fun. We almost missed our flight out there. That was pretty wild. I never would have expected it on Christmas, but we got to the airport earlier than what I wanted, actually, because I fly quite a bit, and I usually get to the airport about an hour before my flight leaves. So anyways, we get there about an hour and 40 minutes before our boarding is done. So that's 15 minutes before the flight. So almost 2 hours before we were there. And when we got up to where the security lines were, well, usually not started, but where the security line was started, it was backed way up. I've never seen it that far. It took us almost the whole time to get through that security line, and then we had to run to our gate. We got to our gate 2 minutes before it closed.
Oh, wow.
It was pretty wild. So that's, me and my wife and then my two kids, and we're like running through the airport to try to get to our gate. We got there, we made it, but it was with some excitement. So it was good.
Well, that's nice. You got lots of powder. I know it's always nice when you're skiing or snowboarding to go on fresh snow.
Yeah, it was a lot of fun. It was fun just to bring the kids there. And even the wife too. I've been to the mountains several times and skied, and there's just nothing like it, at least in the Midwest here. So it was just a lot of fun to get them out there and to watch them actually do their thing. Because, man, it's fun watching your kids and seeing how good they can actually ski. And, you're, of course, as a dad, you're like, yeah, those are my kids. You always think they're better than what they probably are, but still, it's just a lot of fun to watch them and to, see their smiles. So
Cool.
Yeah. Okay. Well, cool, John. Anything else you want to mention before we get started?
Well, not too much. I think, we're just going to get ready here to make it a great 2019. And I suppose we can get into today's topic, which has to do with people who are thinking about investing with other people's deals, and how do you vet those different syndicators and different people that are putting together deals and know that you're getting into with a good relationship, a good partnership.
Yeah. So, I mean, that's really important, whether you're the limited partner, which is specifically who we're talking about right now, but it's also important to understand what limited partners need to know or should know before they invest in a deal. So if you're general partners, you should know that as well. Or if you're bringing limited partners together to invest with a general partner, you should really know, what do we look for. So we've kind of came up with just a few key things, and there's much more that you can do. Obviously, the more due diligence you do, the better chance of having a good, solid investment that you have. And the most important part is that you preserve your capital, right? And so if you give somebody $50,000, at the end of the day, the most important part is to get that $50,000 back, and not to get a check for zero or 20,000 or whatever. So the most important part is to get your money back. Then the next most important part is that you want to actually make some money. But we're really, needing to get our capital back. So that's who we want to make sure we're investing with, somebody that does that.
Yeah. And probably a third one is that you don't have too many headaches or heart attacks along the way.
Yeah, absolutely. You just want to feel, I think it's frustrating. And I've probably been guilty of, or I know I've been guilty of not communicating as effectively as I can, especially in the earlier days of when I was taking private money. And so it's frustrating when they don't get that communication that they want to. So that's really important. That's something that, I try really hard to do, and I'm trying to continue to improve upon that as I, progress in my investing. And that it's just really important. They want to know what's going on, and it's easy for me as an investor to go, well, I know what's going on. I'm not doing anything bad with your money, and I got, this deal is going well. But as the limited partner, when you're not there day to day, you're at your job, you're, going on with your life and doing your thing. But if you never hear from this person that has a good chunk of your money, you don't know that things are going well. You don't know all that stuff. So it's just important to clearly communicate with them. So that's something that I continually try to work on to do better, and just have to continue to get better at that. And I think there's never too much communication. At least I haven't been able to provide that yet. So I, I think it's very hard to provide too much communication with your investors.
Yeah, there's a lot of money on the line there. So, okay, well, what would be one of the first things you'd want to look at when considering a syndicator and partnering with them?
Yeah. So first thing I would say is, what's their experience, right? You want to make sure they've got some sort of experience in, real estate, in money management, in taking other people's money. It's good to know what their history is. Um, so for me, it not necessarily was. People got to start somewhere, right? So maybe their first deal you still are okay with investing in, but what's their experience prior to that? Maybe what's their team look like? All that kind of stuff. So can you feel comfortable with investing in them? I just think back with my first investors. I mean, they took a leap of faith, but they also looked at, who I was. They looked at, my experience. So the first time I took money, I was taking money for a flip. I had already completed a flip. I had already completed, I think, 2 flips before I took my first private money. And I completed several rental renovations. The other thing is I worked construction in the summers to put myself through school and beyond. And I also had a degree which had a concentration in construction as well. So that was all good. And then they also looked at, just my analysis and that kind of stuff. So as far as my experience going when I first started, it was limited, but they also could see, that I had at least some experience, and then I had the right team in place. I think that was really important too, is I had a partner who also had some experience. And then I had some contractors that were already, lined up to be working for me. We had they were the lenders. We had appraisers. We had the property inspection. So we had team in place that was already done.
Okay. And how did you convey what experience you had? Did you provide like a little bio sheet? Did you provide references? Did people really scrutinize your experience, or how did that look?
Yeah. So the first private investor that I had, I did have a little bio sheet for them. I provided them also. Basically, I had a little 3-ring folder, and it showed the previous projects that I had done. It showed some before and after pictures. It showed what we made on it, all that kind of stuff. I also had, for these properties, when I was in my early flipping days, I had an analysis on what it would look like if we flipped it, and what it would look like if we got stuck and we had to rent it. We couldn't flip it for the amount of money. We were still making money as a rental. So I would show them all of that stuff. And then I was just sit down with them and just go through everything and answer their questions and just make them feel good about the investment.
Yep.
I think it's really important. Again, this goes back to what we already talked about, but just communication is really important. If you can clearly communicate from the start why you are a person that they should invest in with, or why your business is a business that they should invest with. That's really important if you can just communicate that clearly and be open and honest with them.
Yeah. So, and like you've covered a lot here, experience in business or some aspect of the business is super important. Probably another aspect of that is just your experience with that investor as a person. So if you have a prior relationship, even outside of business, whether it's at church or Rotary or whatever it is,
Yep.
kids sports, if you can kind of know who that person is, if you like them, if they're honest, if they're, those type of things, then that can help out as well to just solidify that relationship.
Yeah, definitely, definitely. But sometimes that's not possible. Sometimes, like I get calls from people who maybe they heard me on a podcast, or they, read one of my articles, or I responded on, let's call it Bigger Pockets, and they liked what I said, and so they read some of my, other responses, or they just heard about me from somebody else. So I get people that reach out to me like that, and they might be from Arizona. Well, if they're from Arizona, I'm from Minnesota. It's hard to meet. So we have a good conversation on the phone. I put them on my mailing list, and we try to keep in contact as much as we can. Of course, it's hard to keep in contact with everybody on like a daily basis, but you want to just continue to keep in contact with them and get to know them. But how do they know you? That initial phone conversation is really important. It's the content you're providing. So is the person providing good content, and can you follow their investments? I think that's important. And then also references. Are they willing to provide references? And if you ask for more, are they willing to provide more? I've got a long list of investors that are willing to talk with potential investors, and I'm definitely happy to share that. And if they say, hey, I want more, then I'll reach out to other ones. And I think that's really important. Is the sponsor willing to share that information? Are they really transparent? Being transparent is really important. I had a person send me another investment asking me to analyze it. It was very hard for me to say, yeah, I go with this investment, because nothing was very transparent what they were actually doing as a company. It was very, very vague. They seemed to be, I don't know about hiding stuff, but it just looked that way. I don't necessarily know that they're doing it out of, trying to like be sneaky about anything. I think it was just a poor execution of an offering. And so, but that's really important. The more open you can be, the more information you can give, the better. So as the limited partner, make sure that they're giving all the information 100% up front, and then they're willing to ask any questions that you have right away.
Mm-hmm. I know we're not talking about becoming a syndicator necessarily here, but somebody that's interested in this in the future but doesn't have the experience might look at this as saying, well, how am I ever going to get the experience to attract investors? How am I going to attract investors when I don't have the experience?
Mm-hmm.
So I don't know if you have some thoughts or comments on that.
Yeah, I mean, that's, we probably should do an episode solely on that too. But that would be, you gotta build the right team. Again, it comes back to that question that the limited partner should be asking is, what's their experience? Well, maybe they're not extremely experienced, but maybe their team is. Maybe they've got partners that are. So I think if you're looking to be a general sponsor or a sponsor, general partner of some sort, you maybe want to team up with people, especially if this is your first deal, you haven't had a lot of experience in real estate, or maybe none. And now you're trying to get into real estate. You were, let's call it an engineer. Okay. Well, maybe you have good analytics, but beyond that, what's your experience? Okay. It's really hard to, for me at least, really hard for me to invest in your deal as an engineer, if that's the kind of the only expertise you have is analyzing numbers. You haven't seen the real world experience. You know what things look good on paper, and that's it. That's comforting, but only to an extent, right? Because real world does happen. So I think it's really important just to partner with the right people. Or if you don't want a partner, you want to go at it alone, or maybe you and just another partner that doesn't have experience, then start smaller with your own money or with people that are really close to you that it's easy to convince to do deals.
Yeah.
So I think
And
that's important.
the idea of teaming up is, I think, really essential, especially when we're talking about apartment deals where it's really a team sport and you're not going to get too far on your own. So if you can partner up with somebody who has the experience and you can bring other assets to the table and other types of experience, then you
Yeah.
can still get to the destination together. So
Yeah. Yeah, absolutely. And just, you know, you don't necessarily, the thing I like about real estate, that's different from other businesses. And I guess it's kind of similar, but with real estate, you can do a deal by deal partnership. You know, John, you and I can partner with each other to, to be able to work at both of our strengths. You've got strengths, I've got strengths. So we can partner with each other because of those strengths. But then I can also do a deal with, either on my own or with somebody else that has strengths. And you, same thing with you. And that's the great thing to me about the real estate is it can be just one transaction. Maybe we can do 10 deals together. Maybe we can do 2 deals together. It doesn't matter, but we could do a deal and only a deal. And maybe we don't like working with each other for some, whatever reason, or our strengths don't complement like we thought they did or whatever it is. But yeah, just partnering together is really important. But back to the limited partner, it's all about what, again, the main point, what their experience is, how can
right.
they convey that to you. I think another thing is, have they done anything full cycle? For me, I've done some multifamily full cycle. I've done a lot of flips, obviously full cycle. I've done some smaller rentals full cycle. I haven't done any really big deals full cycle. So, okay, so what's your full cycle experience? Well, I've done a lot of smaller things full cycle that I can convey to my limited partners. They can look at what my investors have dealt with through the whole cycle on an investment, and were they satisfied? Did they get their money back? All that kind of stuff. So I think that's important as well, to have a partner that's at least done some sort of deals with private money, full cycle, if you can, of course. That's not always the case, because again, you have to start somewhere. But if at least if you've done a deal full cycle, it's going to be a lot easier to get, your investors to start investing with you.
Yeah. And as the person putting in the money, maybe you don't want to start off with the newbie investor, newbie syndicator.
Mm-hmm.
Maybe you want to start off with a established outfit that has done several deals, try their system out first. And then after you understand how, a proven track record should look, then you can work with a newbie and, kind of give them some feedback about how you have experienced had a good experience and what you see them doing. So that's just another option too.
Yep. The other thing I would say is, what do their investors look like? Are their investors, are most of them just, they've done one deal with that sponsor, or are a lot of their investors repeat investors? Now, of course, everybody can't be a repeat investor because not everybody has unlimited cash. But you should have at least I would say at least 25%, potentially more, that are repeat investors in all the deals that you have. So that's something I'm happy that I've been able to continue to do is I have a lot of repeat investors, and I don't have anybody that I can think of that is invested with me that doesn't want to invest with me anymore. They'll would like to continue to invest. And again, every deal hasn't gone perfect. And I think that's another important thing to talk about is what has happened with deals that haven't gone exactly as planned, and how have you acted on them. And I think that's definitely important, is that you want to make sure those investors, those are great investors to use as references. If I'm talking to the sponsor, if you've got an investor that had a deal that didn't go perfectly as planned, and things went wrong, and you can use them as a reference, that speaks volumes to who you are as a sponsor. So if you've got anything like that, a limited partner, as a limited partner, I would say, hey, can I have a referral to an investor that was part of a deal that didn't go as planned? And if you've got that, if they can provide that for you, and that's a good reference, that's fantastic, because that speaks volumes to how they acted as, the person in charge.
Right. Yeah.
Hey, I want to interrupt this episode real quick to talk to you about Nate Armstrong, our sponsor, Nate Armstrong. He's with homeinvest.com, and you want to get to know Nate. So go to homeinvest.com and just connect with Nate, talk to him, learn about his operation, what he's got going on. He's a turnkey provider, and it may not be right for you, but it could be the perfect fit. So it doesn't hurt. It's a free call, consultation, just to figure out, what they do, what they have to offer. And worst case is you're going to meet a great person who's really well educated in real estate. He's done a ton of different real estate strategies, and probably is going to teach you a little bit, even on a short conversation with him. So go to homeinvest.com and connect with Nate's company. You're definitely not going to be disappointed. It's worth it. So thanks, and we'll get back to our show.
Okay, so after we've reviewed this syndicator's experience and we've become comfortable with the idea of investing with them, what would be the next thing to look at?
Well, real quick before we kind of finish with that, I would say more as far as comfort with them. Do they have some sort of appearance? Are they transparent again? Do they have an online presence? How do they handle themselves on forums and on anything online, on Facebook posts? Are they contradicting? Are they whatever? Are they condescending to people? That type of thing. Just how do they show themselves through their online presence? I think most people are online right now. So, what does that look like? Just doing that research, do they seem like they have knowledge? Do they have good character? Potentially they don't have a podcast. Potentially they don't do a lot of blogging, but they should at least, you should at least be able to get some sort of comfort with them through what you're seeing online, through Facebook, through LinkedIn, through Twitter and Instagram, whatever they're on. I would connect with them, and I would just kind of, look at what their posts are like.
Sure. Yeah. So Facebook stalk them. No.
Yeah, I definitely would. I would Facebook stalk them. I would LinkedIn stalk them. I would, it doesn't necessarily mean they have to be posting every day just to invest with them. But again, you oftentimes will show your true colors, online as you have. The more posts that you have, the more, podcasts you're a part of, all that kind of stuff. Eventually you show a little bit of who you are through that. So I think those are valuable, not to be the end all be all, but those are valuable.
Yep. We definitely do show our true colors online, and that's an opportunity. I know for me as a business professional, I look at that as an extension of my business card. It's a projection of who I am, and allows people to make a decision about if they want to do business with me.
Yep. So if you're on the sponsorship side, or really on any kind of business side, make sure that your online presence is actually kind of who you are. Don't hide behind that screen. I don't know. Some people are just maybe that's who they are, but they just get crazy when they get on these forums and stuff like that. I usually try not to read at the end of like an article, because there's so many crazy people out there. Yeah. So the next thing, John, as you asked, is what's their overall business plan? And is it clear? Again, is it very detailed? Is it clear? Is it well thought out? Like, have they actually communicated that well with you? And that's what I was talking about earlier. When I got sent an investment that I couldn't really say yes to, was they didn't really have a business plan. I couldn't tell what they were going to do to the property other than they were going to renovate it. They were going to renovate the property, and then they're going to raise rents by whatever it was, $125 or whatever it was a unit. But it didn't really give me detail, like exactly what are you doing? Exactly how long is it going to take you? What's my occupancy going to go down to? And I said down, not up. Because while you're doing that, occupancy is going to go down. How long do you think that'll take? What's our lease out? All that kind of stuff. And then I want to know what the market looks like. I want to know, all that kind of, what are the neighboring properties? What's going on? Why do you think this is a good investment? All that kind of stuff I want to know. And that should be on like a detailed business plan. I think anybody's business plan that's putting together a syndication should be just like a real business plan. So it should be, between 6 to 15, 20 pages long. I think mine are probably 20, 25 pages long. I just try to bombard people with information because some people skim through it, but some people really want to read it and understand it. And so if you've got everything there that you understand, it's just going to work a lot better. And the other thing with a good detailed business plan is your lenders know what you're doing. Your investors know what you're doing. Your property manager knows what you're doing. Your contractors understand what you're doing. So everybody on the team understands what you're doing. If you've got a detailed business plan, that means that everybody knows what this project needs to do from start to finish. If you don't have it, how are we going to execute the thoughts that we have in our head?
Yeah, I think, a lot of people probably skip this just because they think, well, it's just real estate. You just buy it and you rent it and you sell it. What more is there? But on the other side of that, you need to be thinking of real estate as a business.
Yep.
If you were going to go put your money into some other type of company, they would have a business plan.
Right.
It would be detailed and thought out, and contingencies and, all these types of things. So if you have this detailed business plan, it shows that you've thought it through and you've taken the time to work it all out. So
yeah, even when I was doing flips, John, I had business plans on every single flip. Not necessarily were they 25 pages long, but I had detailed business plans. I updated, so there's some boilerplate things you could put in your business plan, but you got to update those. Like we're talking about markets, right? Well, if you did your business plan in 2016, you better change your business plan, the particular market, it's 2019. You need to have that updated. You need to get some research done from, Q2, Q3, Q4 of 2018. So you need to make sure you update it, but a lot of that stuff kind of stays essentially the same in your business plan, but then we're dealing with the property specific. So yes, that's just really important to communicate with your goals and what you're doing. So
right.
A lot of this stuff, the repeating theme here is how well do they communicate?
Very important. Okay, so once you've looked through their business plan, and what else do you look at to just make sure this is a good syndicator to partner with?
Yeah, I think really, really important, especially right now, but no matter what, really, really important is their underwriting. And this to me is probably, I wouldn't call it the most important, because probably the who you're dealing with is probably still the most important. That probably always will be. You want to make sure you're dealing with people that are moral, ethical, honest, all that kind of stuff. But to me, the underwriting is is probably maybe the next level, the next step down, what you want to be looking at, especially in this market and where we are in the cycle. I see too many deals right now that I can't put my hands around, and it's a little kind of scary. There's some pretty experienced syndicators that I think might be making mistakes, and of course I would never point them out, but we'll find out what happens. But when you're evaluating a deal as a limited partner, just make sure that you can make sense of the numbers, and don't, here's the problem with I think with limited partners and with anybody is, you might be from California, and in California you're seeing, or let's say and you're from Seattle. Okay, Seattle's been seeing 7% rent growth, 8%, 10%. They've been seeing massive rent growth. And then you're going, okay, I'm going to be a limited partner in a deal that is in Cleveland, Ohio. Okay. Well, Cleveland, Ohio historically sees, close to 1%, maybe 2% rent growth. Well, if the sponsor is projecting a 5% rent growth, because that's what it is right now, maybe it is, I don't know. But if the sponsor's saying, hey, rent growth right now is 5%, I'm going to be conservative and I'm going to project 3%. And you go, oh, wow, 3%, that's it? Oh, that's great. Right now it's at 5. Wow, they're being really conservative. But at the same time, they're actually being really irresponsible, because our typical rent growth is 1% or whatever that is. So you want to look at about what historic growth is. I just was listening to a podcast the other day, and this guy was talking about his underwriting, and he was saying how conservative he is, and that B-class properties in the area he's investing are selling for right around a 5 cap. And what he does is he projects them to grow at 0.1%, 0.1 point per year. So at the end of a 5-year deal, he's saying that it'll sell at a 5.5 cap. But then he went on to say about the cap rates and how compressed they are. And he mentioned that historical cap rates he was talking about Dallas. So in the Dallas area for a B-class property are 7.5%. And I went, whoa. So you're telling me that you're projecting 5.5% at sale, but historically 7.5% is normal. That's scary. That's very scary, because very likely, eventually it'll get back to average. So 7.5%, which means he's 2% under, where it's going to sell. So that's a big difference. And so he thinks he's being conservative. Maybe his investors think he's being conservative, but in reality, I think he's being very irresponsible, very optimistic. Yeah.
Okay. So it sounds like not only do you need to be reviewing the syndicator's underwriting, but also kind of fact checking it against other market data, your own research, to make sure that the numbers they're projecting make sense.
Yeah. Yeah. What are they giving you any data that shows historical value? Like, or are they just saying that, today's cap rates are at 5% and I'm projecting them to sell at 5.5%. So I'm being conservative. That doesn't make any sense to me. That's not conservative. So same thing with any of that. We're talking cap rates only, but with vacancy rates, I'm seeing people underwrite at 3 to 5% vacancy. Well, if it's historical at 8% vacancy, you better be writing at 8 or worse. what are historical values? Now, the only time historical values don't really align a lot with the property is when there's been some major change. For instance, if you invested in an area that's really gentrifying, it was a D class area, 20 years ago, and now it's worked its way all the way up to a B plus class area. Well, that's different, right? We can't really go with historics in that neighborhood, but what we can do is look at what historics are in other B plus class neighborhoods in that kind of area, that city. And then we can use those historical values. So sometimes historics don't make a lot of sense, but we always can compare it to somewhere else within that general area.
Yeah, and it probably also should be mentioned that you're going to have a few different projections. You're going to have like the most likely scenario, and you're going to have a best case scenario and a worst case scenario, and all of those scenarios should be thought out and written out as part of that business plan.
Yeah, John, I agree. That's a really valid point. And a lot of, I think a lot of sponsors don't do that. I think that's really important. That's something I enjoy, doing is I look at what are some different scenarios that could happen, and what does the investment look like if those scenarios do happen. So I think that's really important, is do they understand where things could go wrong? And if things do go wrong, like what are our options? What do we do? We got to plan for failure, to an extent. Obviously you don't want to, just plan for the worst, but you do want to plan for some sort of adversity, things to go wrong, and then how do we make those things go right? Because things are going to happen during your investment. You can't control the market. To an extent you can help manipulate it, but you really can't. I can't control when the next recession is going to happen. I just unfortunately can't do that. Wish I could. I'd like it to happen right now. I'd like to buy some cheap real estate. But yeah, I think it's really important just for them to understand, and the other thing is, what are the plans if a recession does happen during this holding period? What are we going to do? Is it going to be a sell for sure in 5 years? Or do we have a plan to hold it longer? What does that look like? How do I get my money out? All that kind of stuff. So you want to look at, what is their overall plan, or what are they looking at as far as underwriting? Is it being conservative? Are they basing it on historicals, or are they just, basing it on today's market? When everybody, I think, understands that today's market, we're closer to the top than we are the bottom. So things have been heated up. Could they continue? Sure, they could. Maybe that'll go on forever. I just don't think so.
Yeah. Well, I wanted to dig into this a little bit more, just in the sense that, okay, if we're talking to an investor who's got their own full-time job on a different type of work, and they've got their family and they've got their hobbies, and they want to put some of their money to work. So they're not very familiar with the particular market in this particular offering, So how do they bring themselves up to speed in a short amount of time with the kind of key factors to know that their syndicator is looking at the numbers correctly?
Well, for one, the sponsor, the paperwork that you're looking at, the business plan that you're looking at, should give you that information, and should give you references to how they found that information. So that's really important. I think that right there is a responsible general partner. They're trying to give you the most amount of information possible, so you don't have to go and spend 6 hours to look at it and to verify it. Now, you do want to do at least some due diligence, right? You don't want to just count on what they pulled up on the internet, because we know reports can be conflicting. How you look at that? Well, if you've got access to brokers and that kind of stuff, you can ask for like a CoStar or a Reese report. If you don't have access to them, everybody's got access to a lot of online publications. So there's publications such as like CBRE, Marcus and Millichamp, Colliers, Cushman Wakefield, all the big commercial brokerages, usually SVN, they usually put out at least minimum annual reports on most major cities. Now, if you're in a small, little, tiny town, it might be tougher. You can also just do simple Google searches. You can look at, what's the population growth, what's the employment growth, all that kind of stuff, and just make sure at least what they're presenting in their business plan makes sense. If it like, wow, this looks like their information, the business plan is from back in 2014, and in 2018, we're projecting, employment losses, or this big company moved out or whatever. Now, okay, maybe they didn't do their due diligence, but yeah, you should be able to do some internet research and really get some general understanding of it.
Right. And once you have that, you can go to that syndicator and say, I read this and, either you didn't include it or it looks a little bit different than the numbers you provided, and give them a chance to respond. They might have an explanation. They might be able to just discuss it and at least.
Yeah, John, I think that's a very valid point, because if you go, well, hey, what's going on here? You're showing that there's going to be a, gain in employment. I'm looking at this report. It says there's a loss, and it says this big company moved out, and they can go, well, yes, that company did move out. However, these three larger companies moved in or are moving in, or this is a major investment that's being made in the area. And you can go, oh, now you can do some more research and find out that, yep, they are right, or maybe they're wrong, but you can find out at least, and validate what they're, saying.
Right. It allows, sometimes that dialogue can go a lot further than just reading a report.
Mm-hmm.
So it can help you get more comfortable with what they're projecting there.
Yep, absolutely. Yeah, maybe you're not, sometimes you're not concerned as much, and I say this with a grain of salt, but sometimes you're not as concerned as much about, maybe a big company did leave town, or a lot of jobs did leave, but maybe that investment's still a really valid investment because it's an area that's getting infused with a lot of money. It's really got some good growth. Maybe it's a particular little sub market in that overall market that's seeing major things positive happening, even though the overall market did get a smack in the face, where that sub market is really, really strong. So sometimes there is reason to still invest in a particular area if it did have some job loss or some population loss.
Yeah, every market's got its own story, and there's sub markets within markets. So got to make sure you're looking at the right data. So.
Yep. And that's the other thing. Now, it's the opposite is true too. Just because a city is seeing good growth doesn't mean that sub market is a positive place to invest. So you just want to make sure that sub market's actually positive. And is that sub market growing? And is there positives happening in that sub market, not just the overall in the city? Because, you look at a city like Minneapolis, well, we're 3.6, 3.8, whatever million people, but we can narrow it down and pick out one particular area that might be losing population, and that we don't want to invest there.
Yep. Okay, well, we've covered quite a bit, but there's still a few more things here. What would be the next thing to look at with picking your syndicator?
Well, I'll run through some of these a little quicker because I want to wrap it up. But the next thing, we already talked quite a bit about this, so I won't really talk much more on is the team. Understand their experience, property managers, contractors, appraisers, inspectors. Just want to make sure that everybody's on board with this property and that we all have a business plan we can execute. So the next thing after that is the investor actually, or is the sponsor actually investing in the deal? So I think it's important to at least invest the minimum. And so typically your minimum is going to be, like 50,000 or maybe 100,000, whatever it is. I think the investor needs to at the very least, invest the minimum. Probably potentially more than the minimum. But so if your minimum's, let's say, $30,000, I think 30,000. Yeah, I think that's a small amount to invest. To me, you should be at least investing 50,000. So I think that's really important. It helps tie them to the property. It helps incentivize them to make the deal a win. If they don't have any money at stake, it's going to be tough it's going to be easier for them to maybe walk away. So the more money they have involved, to an extent, I mean, you don't expect them to put in, $500,000 or $1 million into every investment, because you're going to run out of money. But if they've got 500, if they got 50,000, if they got 100,000, I think that's going to tie them to the investment a lot better.
Yeah, you want to have some skin in the game, as they say.
Right. The other thing dealing with money also is you want to make sure that as a limited partner, you want to make sure that the general partner is going to get paid. And you may say, well, that takes away my profit. Well, sure. But if I'm not making any money on the deal and things start to go bad, do you think, personally, I would, but there's a lot of people that wouldn't spend a lot of time on it anymore. And so if they're making money on deal Y and deal X is failing and not making them any money, which one are they going to focus more energy on? Probably the one that's making them money. A lot of people would. So you just want to make sure everybody's making money, and that you're not the only one as a limited partner that's making money. So you should be able to look at their underwriting very clearly and see how much money they're making. Is that enough money to at least incentivize you as a limited partner? Would that incentivize you to keep going when the going gets a little tough? If it doesn't, you may want to reconsider that investment.
Yeah, and probably part of that is the ongoing asset management fee, I would think. Not just the profit when the deal is sold in 5 to 10 years, but they have something to keep them involved day in, day out as things go on.
Yeah, I mean, if they're not making enough to break even, if they're putting more and more money into this property all the time, and that's, if they're just making a few measly bucks, I mean, that's just hard to make sure they're motivated. You want to make sure they're motivated. It doesn't have to make them filthy rich. It just has to be enough margin to make you feel that, okay, they're going to work hard for this deal, and they're going to work hard for you at all times. You just want to make sure they're going to work hard for you at all times.
Right. And there's a lot to being a syndicator. It's not, there's all these investor relations and finding the deals and managing all the contractors and property managers. So there's things that need to get done that is their responsibility, and they need to get compensated for that. So.
Yeah, I mean, I'll just, this week was a short week, but just to give you an example of my week right now, dealing with, just a few deals. We're working on construction on actually two different deals, but I've been spending a lot of time on one particular deal. So I've probably spent at least 15 hours this week on the one deal, dealing with the construction, making sure we're doing a draw right now. It's doing all that, making sure that's all in line. I was on the phone yesterday with my property manager 2 different times. I was on the phone with the on-site manager. I was on the phone with the contractor. Today, while you and I were talking, I missed a phone call from my property manager. I'll be calling him right when we're done here. I've got a scheduled call at 2:45 today with the property manager. We've already exchanged several emails, and I am working on writing our 2019 business plan and goals, which I do every year. We give our investors an idea of where we think the property is right now and where it's going. And then we're working on buttoning up the 2019 or 2018 year-end statements and stuff like that. So I have, on a short week, have already spent probably, close to 40 hours or 30, sorry, maybe not 40, probably more like 30, 25, 30 on just these couple properties.
And you're a nonprofit, right?
Yeah, I'm a nonprofit, right? Some of them feel like it. No. But yeah, I mean, that's just how it is. It's not like as a general partner, you're just sitting and collecting checks. You better not be, otherwise you're not really serving your investors. So you better be busting your butt. Some weeks are a lot more work than others. Year end and year beginning, for me, at least how I have things set up, there's just a lot of time and effort put into it. I'll be spending 40 plus hours a week on my investments, and then I also have other things to take care of as well with my business. So I mean, these first few weeks and last weeks of the year are usually really long days, but that's just how it is.
Yep. Okay. Well, what would be one of the maybe last things to wrap up this topic as we think about vetting our syndicators?
Sure, John. The last thing I would say is just make sure you're aligned, right? Make sure for me, my philosophy is only do business with people that you like and trust. So if you don't trust them, if you question that, if you question if they're ethical, that kind of stuff, I just wouldn't even do business with them. So if you question their intentions or anything like that, just don't do business with them. So deal with people that you like, and deal with people that you can align with.
Yeah, and keeping in mind that it's a big world, there's lots of other opportunities out there. So
a lot of people get caught up in that shiny object syndrome. It's the same deal. So as a limited partner, you go, wow, these numbers look really awesome. I really like this deal. Well, look at how great this property is. I'm not. Yeah, I mean, I don't know if I would invest with this general partner if the deal wasn't so great. But the deal's just great. I'm going to invest with them. Well, that's a terrible approach. You should say, I really like this general partner. They're great, all that kind of stuff. And maybe even the deal is marginal, but they're great. That's what I would rather invest in that than the opposite.
right. Sounds like good advice.
Well, cool, John. That wraps up my thoughts on limited partners and what they should be looking for. Of course, there's, it's just a lot of due diligence. I would say you should be doing as much due diligence as a limited partner, maybe not quite as much because you're probably not going to the property and as much and all that kind of stuff, but you're not going to walk every unit likely. But you should be doing due diligence on the investment. And you should be able to have the opportunity to go to the property. That's one thing that, any of my investors, if they want to go to the property, more than happy to try to either meet them or make sure my property manager is able to meet them and we can get them into the property. So.
Very good. Well, so to our audience, if you have enjoyed what you've heard here and you want to contribute either something that we maybe didn't quite cover or just to expand on what we did, be sure to look us up on Facebook. We are Pillars of Wealth Creation, and we'd love to have a conversation with you there. And while you're online, give us a good review and rating on iTunes, and make sure you're subscribed to us on YouTube so you can watch the episode as well.
Awesome, John. I appreciate it. You have a fantastic rest of the day.
You too.
Like every day Saturday, man. Are you ready to start investing in real estate today, but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today.